But if you wanted to have very little risk over the next 7 days, you can do this collar, what I call a tight collar. And that's bringing in the walls of the options. You're bringing these in here. You're making these closer. So if I sell this here, I want you everybody to keep an eye on that buying power. If I sell this, it's gonna be about 36.25. So I want to buy something for no more than 36.25. So let's say we buy this 61.35. We're doing a tight collar. Look at that buying power now, you guys. Goes from 23,000 to 1,200. Or if you was, instead of doing the SPY, this is the same thing. This is the S&P 500. Instead of doing the SPY, using $30,000 in the margin account, 60,000 in an IRA, you're using $1,200 in this ES. I want to talk about a tight collar, and I'm going to explain the collar strategy quickly, super quick, and then I'm going to talk about the tight collar. And I'm going to use two different underlinings to describe it. I'm going to use the SPY, which is the first ETF ever created. An ETF, as you know, it's like a mutual fund that trades like a stock. And the SPY is the most popular one. It's the first ETF ever, and it's the S&P 500. It follows the top 500 publicly traded companies in the United States. Okay? These kind of indexes you can use to beat the market. And what you've heard me talk about in the past is beating the market 99+% of the time. And the way you can darn near guarantee yourself that is trading against the actual index. And so the way I like to do it is using the SPY, using the UPRO, using the micro E-minis, using the E-minis, talking about the futures when I talk about the ES type of thing, right? Let's do it 7 days. We're going to go 7 days just to satisfy the short-term traders and just see how well this can work in a very short period of time. It can also work well in a 30, 90, or even longer time frame. So when you are doing a collar, you are buying 100 shares. I'm just going to put S for shares. You are selling a call. You're going to sell a call. Okay. And you are buying a put. That is the dynamics or the structure of a collar strategy. You have shares, you have a call that you sell, you receive monies for it, and you buy a put for less than what you receive for the call. The overall trade is a net debit initially. It's because you are buying the shares. So let me break this down. If I go here and I sell this 613, the 613 strike here, I've already bought the shares, as you can see down here, bought the 100 shares, and then now I'm doing a covered call. When I do the covered call, instead of just staying with just the covered call, I'm going to take some of the monies, which we're getting about $166, and I'm going to buy a put for less than that. So in this example, let's say we bought the put at the $5.99. Well, in this case, we're going to be receiving about 20 to 25 cents in credit based on the options themselves, this put that you bought and this call that you sold. Now, what happens with this is that when you don't have the put on, you have risk with a covered call, just like stock that you purchase. You have risk all the way to zero. As you can see, this SPY is trading at $60,000 to get 100 shares. So if it went to zero, which it's not, but you want to understand it, you want to understand your technical risk is all the way to zero, then you have $60,000 worth of risk in this example here, even though it's a covered call. A covered call is bullish. But if you wanted to remove that risk and kind of define how much risk you want to have, do you want to have 2% risk, 5%, 10%, 20%? How much risk you want to have, you can define it by using what we call the collar strategy. So if you take that collar and you buy that $5.99 as we were talking about here, and you can see if we look at this now, instead of having $60,000 worth of risk now, you only have $800 worth of risk. So you remove and define your risk to the downside by doing a collar. This is why I absolutely love the collar for not only beginners, but experienced traders, how to remove all the uncertainty out of the markets. And you guys know this year we've had a lot of uncertainty. I've been saying that some of you have got 10 years, a decade of experience in just 6 months, because we've seen the gamut of all these different things that's happened over the last 6 months. It's been amazing in retrospect. Some of the times it's been frustrating, it's all get out. But right now, as I speak, I'm thinking it's been an amazing 6 months, first 6 months of 2025. So this is the collar to define yourself. It's not a wide collar, but it's closer to a wide collar than a tight collar. So as you can see here, you can make as much as $600 and you can lose as much as $800. Now, some of you might say this is a tight collar for you, right? Maybe your account is a decent size or whatever the case would be, and you're okay with this type of risk, which is perfectly fine. But if you wanted to have very little risk over the next 7 days, you can do this collar, what I call a tight collar. And that's bringing in the walls of the options. You're bringing these in here, you're making these closer. Before we continue with the video, I just want to quickly point out, if you need any additional help, please consider joining our trading club. You can do that by clicking on the link in the description area, and you'll get a 3-month trial for a flat fee of $60. We look forward to seeing you in the trading club. Back to the video. Right? You bring in the put closer to at the money. You bring in the call closer to at the money. You're going towards the at the money line, which is this orange horizontal line here. Okay? So it's still the same dynamics. You want the call to be more than how much it costs to buy the put. So you want it to be an overall credit for the option part, but the overall trade will be a debit because you're buying the shares as well, which is the major part of the trade, the biggest component of the trade. So if I decided I was going to move this up to the 609, move the call up to the 609, closer to at the money, and I'm receiving now 300 and something for the call. If you look at this right here, let's say I'm receiving like 323. So I need to buy a put for no more than 323. So if I say I buy the put for the 605, well, so now you see that this is a tight collar. Over the next 7 days, I can make up to $200, and the most I can lose is just under $200, about 180. It's very, very defined and tight. But you do this type of trade because it's a short-term directional play that you're betting that the market is going to jump up, or the underlying that you're doing it, and you're betting it's going to jump up over that time frame, and you're trying to just get some of that money. So you're not trying to get a ton of it, but you're trying to get some. In this case, you're trying to get about $200. And you're risking just under $200 to do it. So a tight collar. If the overall market drops down to 600, that's fine. You're not going to have to realize any losses based on your shares. You will just adjust the options. And we teach you how to do it when you go learn about the adjusting process in that course that I was talking about earlier, the ultimate adjusting course. And obviously we teach it when you do the safeguard cohort, or if you look in the video library, you can learn a ton about the safeguard strategy, right? Every member of Dorian Trader get the video library for free as a member. Go look at the safeguard title in the video library, look at those 4 or 5 videos there, study it. And you can also marry those kind of studies to the videos we put in Discord. But I want you to understand this at a high level, because this can be a awesome strategic type of strategy that you use. You can do a tight collar like this. You can do a semi-wide collar, or you can do a very wide collar, but you're still defining your risk to the downside. It's never going to be all the way to zero when you're doing a collar strategy. Okay? And you're obviously never going to have unlimited upside when you're doing a collar strategy. But you're not doing this type of strategy for that purpose. You're doing this to kind of have peace of mind to the downside, but still wanting to participate to the upside. And that's exactly what this has been for us all throughout 2025. And if you do this strategy into perpetuity, which I hope most, if not all of our members do, at least to some degree, then that's going to be the case. Okay. All right. So this is the tight collar that I wanted to talk about. Obviously, I don't have a time to talk about every detail about it, but I'm going to open it up for questions now. Any questions?
Oh, Brian, I have a question.
Okay, go ahead.
So you're putting out a lot of money to buy 100 shares at $607. You're using a buying power of 30,000 and change. And
Oh, you know what, Betty? You just reminded me that I wanted to do a comparison. I said I'm going to look at 2 underlines.
Okay.
Well, in this case, you're putting out, like you said, Betty, you're putting out $30,000 to do this trade, buying power wise, in a margin account. If you're using a IRA account, it's going to be a lot more than that. Okay.
Correct.
So what I like, and you can do this in an IRA account as well, especially with TastyTrade. You can do it with Thinkorswim as well, I believe. And so what I'm going to show you is doing this in the ES. Remember that buying power was $30,000. So we're going to go apples to apples, and we're going to look at the ES to do this. And so if I buy the ES future, which is $50 a point, that's how much you will make or lose based on each point. Okay, $50. That's the denominator for the ES. As you can see, if I just buy the future outright, it's going to be $23,000 in buying power. But that's still a lot. So let's look at doing a tight collar. So if I sell this here, I want everybody to keep an eye on that buying power. If If I sell this, it's going to be about 36.25. So I want to buy something for no more than 36.25. So let's say we buy this 61.35. We're doing a tight collar. Look at that buying power now, you guys. Goes from 23,000 to 1,200. Or if you was, instead of doing the SPY, this is the same thing. This is the S&P 500. Instead of doing the SPY, using $30,000 in the margin account, 60,000 in an IRA, you're using $1,200 in this ES in buying power. Same tight collar. It's not giving you on this platform the max profit and the max loss and so forth. So you have to do the math yourself. This is like understanding the basis of options, though. You understand the denominator. It's $50 a point. So if we took the 61.35 and subtracted from its currently price 61.49, and that would give us, so 61.49 minus 61.35, that's 14. So 14 times 50 is $700 risk to the downside in this example here. Let me do that. Yeah. And then to the upside, if you take that, let's just say it's 6 points to the upside. So 6 times 50 is 300. So in this example, you're looking to try to make 300 and you're risking 700. Okay. So
Right.
can you do this tighter? Yeah, you can do it tighter if you wanted to. If you wanted to go like that, that's super tight, right? So it's even tighter. So now it's a 61.40. So that's 8 points. So 8 times 50 is 400. And so instead of your risk, you're trying to make, let's say, what does I say, 300? So 6 times 50 is 300. Yeah. So now you're risking 400 to make 300 in this example here.
Right.
So this is how you can use your capital a lot cheaper. Yes, sir. Everyone has this question initially, right? But it's just thinking as this ES futures contract. Just think of it as shares. It's not shares, but just think of it as shares so that it won't confuse you, right? It's just like buying shares, but these shares have an expiration date. They expire every quarter. They do not have time decay. The difference between a futures contract, the main difference between a futures contract and a futures option or options period is that the futures contract doesn't have time decay. As you guys know, options all have time decay. So it's just that you would have to just move or sell the future when it's expiring and buy the next future. It's not time decay that you're dealing with though.